The narrative on Meta has shifted. We aren't looking at a social media company anymore. We're looking at the world's most efficient cash flow engine, funding the world's largest AI infrastructure build out. The bear case is that spending is too high. The bull case, my case, is that the spending is a new mode. In the next 5 minutes, I'll show you why Meta's 40% operating margins are just the floor. First, the engine, family of apps, Instagram, Facebook, WhatsApp is now touching 3.4 billion people daily. But forget a user count. Look at efficiency. Ad impressions are up 20% year over year, driven entirely by AI recommendation. They didn't just survive the TikTok trend, they neutralized it by becoming better at algorithmic sorting than by dance. Let's look at the fiscal year 2025 numbers we just wrapped. $201 billion dollars in revenue. That's 16% jump on a base that was already massive. But the real story is the 83 billion dollars in operating income. Even with the reality lab losses, the core business is printing cash at margins that the hardware companies can only dream of. The financial fortress, it was allows Mark Zuckerberg to play offense. Wall Street hates the Capex spend, projected at $45 billion for 2026. I take the opposite view. This capital expenditure is a barrier to entry. To compete with Meta today, you don't just need code, you need $100 billion GPU cluster. By front loading this spend, Meta is effectively pulling up the ladder behind them. No startup can afford this compute. Why give away Llama for free? It's the Android strategy all over again. By making Llama the default open source model, Meta ensures the world's developers optimizing for the architecture. They are commoditizing the complement. If the model is free, the value accrues to the proprietary data, artificial network, both of which Meta owns exclusively. This is a massive strategy. To talk about Advantage Plus, this is Meta's fully automated ad suite. It's no longer about targeting males 25 to 34 in London. It's about giving the AI a budget and the creative assets and letting it find a buyer. This has restored the signal loss from Apple's ATT changes. Advertisers are now spending more because the return on ad investment is undeniable. WhatsApp Business is the sleeping giant that woke up. Click to message advertising is now $10 billion run rate business. In markets like Brazil and India, this is the entire economy. It's not just messaging, it's the commerce layer. We're effectively seeing the WeChatification of WhatsApp, and it's entirely accretive to margins because the user base was already there. I assign zero value to the metaverse in the valuation. I treat it as a pure expense. However, the Ray-Ban smart glasses are a different story. They are the first successful AI hardware form factor. If Meta captures even 1% of the eyewear market with multimodal AI assistant, the Reality Lab losses shrink rapidly. It's a call option on the next compute platform. Bear case always cites regulation, but look at the landscape. The FTC is stretched thin, and breaking up a company integrated by AI infrastructure is technically nearly impossible. Furthermore, in a geopolitical race for AI supremacy, US regulators are unlikely to hamstring the national champion. The regulatory discount on the stock is currently mispriced. Let's talk about price. Meta is trading at roughly 22 times forward earnings for a company growing double digits with a 40% margin profit and the best AI infrastructure in the world. This is a disconnect. The market is pricing Meta like a utility, but it's growing like a tech stock. That multiple expansion is the easy money in this trade. Finally, management alignment. Zuckerberg owns the company. Essentially, he wants the stock up. They introduce the dividend to open the stock to income fund, and the buyback program is relentless, reducing share count by 3 to 4% annually. They're effectively cannibalizing their own float at undervalued price. This provides a soft floor under the stock price during volatility. In conclusion, you have the best balance sheet in the sector, the most aggressive AI strategy, and a valuation that allows for safety. The capex is in the berg. It's a future. We remain high conviction on Meta. If the efficiency holds, we aren't just looking at new highs. We're looking at a path to a 1,000 share price by 2027. Thanks for watching.